And how can I find this? Maybe there's some, because it's supposed to be available, yeah, online, so at least we can find it in the future as well. Okay, so in case of mortgage-backed securities, we have to determine several things. So first of all, the longevity. So how long the mortgages are repaid. The next thing, that what happens when they are paying back the loan earlier, so early repayment. Obviously, they can define some extra commissions on this to motivate the clients not to pay back earlier, but still, if there is early prepayment, then they must invest it somehow, so that's why they are purchasing government bonds. So and also there is a lead lag situation, so how long the money is collected and the transaction happens or moves until it reaches the bank, and after that it reaches the client. So transaction times as friction, and also how many tranches do we have, because practically if we are securitizing mortgages, then we are selling the cash flows, and in this case, since our clients are repaying not just interest but also the capital as well, so if we are defining the tranches as sequential packages, so the first sequence is for the first, let's say, 5 years. This will be the most secure thing, because usually people are starting to go to default later on, so time and probability of default are linked together somehow. So these are the best, or this is the best tranche. This will be the most secure asset, and also we can say that yes, if we are determining the present value of it, it will have the highest value also at the same time. So it's best from all the different aspects. And after that, maybe there is a second tranche, there is a third tranche, but at the end of the day, the last tranche, which covers or it runs until the expiry date, this is the most riskiest. So most of the defaults will be affecting that one, and also all the early repayments will generate a higher and higher government bond content to this one as well. So the possible interest revenues will go down because of credit spread between the clients and the government bond. So sometimes this tranche is referred as the equity tranche, and usually they are not able to sell it. So the first tranches are much more popular, but this is also assumed. So in the case of the tranches, until the first one is not paid out completely, then the other tranches are not paying the capital, just the interest rate. And once they are served, then the next tranche starts to pay up the capital, but until the laters are still paying only the interest. And once it's served, so that's why it's sequential. So so these are the rules, and after that we should define structure. And also nowadays it starts to become quite popular among banks that, or not banks, but mutual funds, that if they need some kind of fixed interest asset, they are not adding or putting the money into bank deposits or purchasing government bonds, but they are using SPV notes. And inside the SPV note, this is a special purpose vehicle note which is always linked to securitization. There can be, so it's a note, so it's a short-term bond, but since it's SPV, so its value, so it's a portfolio of different assets or previous bank assets, so it can be some government bonds, some loans from the asset side, so it can be like a sausage. So we are taking something which pays interests, and we are just linking it to this portfolio, and even guaranteed funds are running under these operations. Okay, so we have a principal. So this is the capital inside, or all the loans, the entire loan portfolio, which is 100 million, let's say, US dollars. We have the gross rate, we have the coupon rate. So the gross rate will be the mortgage interest rate. Last year I was taking up a mortgage for 25 years with 5.5 interest rate with a fixed rate, so practically I can say that I'm really close to this example. And the coupon rate is related to the treasury bond. Okay, original term, so it's for 30 years. Time remaining is the same calibration. And after that we have this speed thingy, and so this is related to the early repayments and yes. Yeah, this is related to the early repayments. Just my problem is that it's really hard to calibrate this one. So I try to check or look for other descriptions, other tutorials, not at Matlab, so at BIS and other nice places. And practically the model behaves like this. So there is a speed, and the speed calibrates it somehow. I will show you that what happens if we are changing or playing with the speed, but this is the early repayment feature. But we cannot. This is like a percentage, but it's not in days or weeks or something related. Just it's a calibration number. This is how fast the transaction goes through from the client to the bank to the bondholders. So this is in days. Yeah, settle date, issue date is happening this way. So well, let's say that instead of these numbers, let's calibrate everything to my special case. So 25 years. Okay, early repayment is this one. I don't want to interfere with that. And okay, coupon and growth rate, we can imagine that is good. And Okay, I'll also have to change this one. Then it is happy. Yeah, so these dates are the Matlab date formats. So if we can see that there is some up-to-date calibration or this date num, so they can jump back and forth between the official date format and their own numbering scheme. Practically, if we are increasing this number, then we are going one day further. So they were able to use this conversion. Okay, next thing. Calculate the underlying cash pool. Here we can see that nothing happens at all. So if we are just executing this one, we can see that it will be just organized in the following way. But, yeah, so this is what this is what gives us that, okay, the underlying curve should look like this. So at the beginning, okay, they are defined payments, and after that it increases until some points, and after that they start to repay the capital, and after that everybody will be happy. And this is running out. But this variable is not considering any kind of amount. So this is just solely for time. So how long this whole procedure will be. Gross rate, so practically the interest rates, coupon rates, delay, speed. So this is quite dumb in terms of calibration. Then so prepayments must be added, because still we have this unit principle, so we don't recognize that how much money do we have, and unit interest also is defined. So we have to pay that. Okay, if we have prepayments, then already they defined the unit prepayment, sorry. Yeah, so the speed is already recognized here, that what is endangered, and practically what will be repaid at the lower coupon, or what will be paid at or invested at the lower payment. So this is just the calibration of the principal. So this is when we are recognizing that, okay, now principal payments will be linked to the underlying capital. So now we can see that this is the lot of money, and after that this starts to run out, and that interest, prepayments, and other things will be affected. But this is still calibration. This is not step 1, this is figure 1. This is the plot of the underlying MBS payments, because that's why I like this tutorial, because it shows us that how money looks like. So we can have the all the principal payments, including prepayments. So this is the money what we are collecting from our clients. So this is time, until it's repaid, so we are paid for 300 months. And also interest payments, they are nice at the beginning, and after that they start to go down and down and down, because the amount of capital is also decreasing, so until the last part is repaid. So this is looking fancy, but what is really important for us, that how can we so practically this is not step 5, this is step 4. So now we have to create a bond from this asset, so that's why we need speed. And so this can be calibrated. So these are in months, and we can set this back speed that until expiration. So right now it's set until expiration. It was not set until expiration, just I was changing the timeline. So let's say that 4. After 1 year something will happen. And then we will see its effect. So we can see that how the principal is scheduled. And if I'm setting this thing in the future, so once it's started to be repaid, then this thing should increase. Just let's copy figure. Don't need this one anymore. So let's decrease it again, because so by setting the speed variable up, practically this part is increasing, so they start to pay a lot at the beginning, and obviously since they are paying a lot at the beginning, after that not so much money will happen, so in the future we start to run out faster. So we can see that at 100 months we have 2, and in 100 months also we have 2. So let's see, less than 1. Okay, so in 200 we have way less than 1. Scaling is not the greatest, but at least they're supposed to be lower, so not just in this case, but at the end of the day. So let's be much more aggressive than 50. Oh no, I cannot be 50, because in this case it would be negative, so 20. Come on, please go next to each other. So this is the aggressive one, and it's even bigger in the payments at the beginning. This is the smooth, and so it should run out faster if the scaling would be the same. But let's go back to the smooth scenario. Yep, not this one, that one. Oh, they existed. Okay, usually they are overwriting it, but it was not overwritten. Then we need cash flow. And the funny part is that we can define the coupons for the tranches, which is the same like the treasury bond tranche or the treasury bond interest, which and now we can see that okay, support capital, so early repayments will happening here because I calibrated this in this way. They had no chance to repay in the early part. Wow, cool. And okay, just but what the funny part is that even if they are running out of cash at the beginning, so how can they survive until 3? Yeah, they can survive until 300 because this is how I calibrated the whole package. Sorry, right now they are forced to early repay everything before here because that's what I have done here. Yeah. This is my footprint, and after that all the money is going into government bonds. But still, if there are some kind of early repayments, it's supposed to be here, then these interests are also located here. Just we can see that after that it will be a bit more fatter. So let's see that what happens if I'm less aggressive. So let's say that rolling 4 years and 20. Okay, now it's much more nicer. So we have, they start to repay earlier, and then most of the money starts to flow into government bonds due to early repayments, and this is amortizing in a nicer way, and also we can see that, yeah, support interest payments, so government bonds are also paying nicely. And sooner or later this asset starts to operate like a government bond portfolio instead of mortgage-backed security. So this is a really funny thing, because practically only with the right calibration of the early repayments we can create a diversified portfolio. We don't need any additional parameters. So and after that, let's split these things to pieces. Step, no, not 7, it's step 5. Just creating a figure is not a step. 6. So we can create these tranches. Well, obviously we can say that let's create only 2 tranches. There will be the best one and the okay, or let's create 3 of them, because at least we can see some extra. So the primary tranche, the secondary tranche, and after that what remains there. And also we have tranche coupon Z. And also let's generate cash flows for each tranches. And after that we can see that how does it look like. So now you can see the behavior. So the first tranche, so the first security, is paid until this time period. And also it's really funny that we don't have to calibrate the longevity. We have to calibrate only the capital. So until the first part is paid, then it exists, and after it's paid out, then the second tranche is online, then they start to pay, and after that this is what remains here. Which can be also funny because I mentioned that this can be assessed as the most risky part, because maybe the non-performing loans will be accumulated here, but also at the same time, because of the early repayments, practically we can find the most government bonds here. So and after that we have to determine the present value. So how can we sell these bonds? So this is step 7. So obviously we need the discount curve. It's also much more sophisticated than just providing one discount number to everything. Here we have the curve for the different time periods, so we can run practically discounting under different for different maturities with different interest rates, which is cool. Then we have to determine the the value. Price the CMO cash flows, yeah. So these are the values. Because if we have cash flow, then the present value will be the value for it. So, yeah, this is the value for the first one. If we have a yield, okay, then we have the second one. Okay, this will happen only in the near future or far future, so the value is decreasing. And here we have also the spread. And after that we have this weighted average life for the first tranche, which is in years. So practically, if we would like to compare it to another bond on the market, then we should look for the maturity of such a bond. So it helps us to locate it at the yield curve, and that's why we can compare it. If we have this yield of 4.8%, then is it better or worse than what we can find at the market? 3.8. We have only 3 and 5 here, so 1, 2, 3, 4, 5, 6. 1, 2, 3, 4, 5, 6. Oh, that's way better because the zero rates are way lower in both of the maturities. So practically this is a great deal to buy this.